Taking advantage of the Registered Education Savings Plan account helps to make post-secondary education more accessible for children and less costly as a parent or grandparent. The Registered Education Savings Plan, referred to as an RESP, is a tax-sheltered investment account with the sole purpose of funding post-secondary education costs. When you set up the account, you are considered to be the subscriber. If you're married, then both you and your spouse can be subscribers on the plan. Your children or grandchildren are set up as the beneficiaries on the RESP. If you name more than one beneficiary on the plan, this is known as a family plan. Contributions you make into the plan grow tax deferred, and when they're withdrawn for qualifying post-secondary education costs, the investment income and government grants are taxed in your beneficiary's hands. Although investment income and government grants are taxable to your beneficiary, most times no taxes are payable, as your beneficiary may have income below the basic exemption or have tuition tax credits. Capital that you contributed into the plan can be withdrawn tax-free. When you contribute to the Registered Education Savings Plan, the federal government will match 20% of your annual contributions up to specified maximums, and this is called the Canada Education Savings Grant, or CESG. The government grant arrives in the account, usually 1 month after making the contribution. Contributing to a Registered Education Savings Plan is essentially a guaranteed 20% return on your money. The annual maximum grant that can be received per child is $500, which requires a $2,500 contribution. The lifetime maximum grant per child is $7,200, which requires contributions totaling $36,000. If you miss contributing to your RESP in any previous years, the government permits parents or grandparents to contribute an amount of $5,000 per child and receive $1,000 in grant money. The optimal way to fund your RESP is to aim for consistent contributions. We recommend doing a lump sum of $2,500 each year in January for each child. If this is not possible, scheduling regular contributions each month to capture all available Canada Education Savings Grant room is recommended. If you begin contributing $2,500 from year 0, you'll need to continue these contributions for 14 years, plus 1 extra year in which you contribute $1,000 to get the maximum grant of $7,200. We will help you form a withdrawal strategy which can minimize taxes and avoid losing government grants. There are 2 types of withdrawals you should know about: post-secondary education payments, called PSE, and educational assistance payments, called EAP. A post-secondary education payment is a withdrawal of the original contributions into the plan. These amounts are tax-free when withdrawn. Educational assistance payments include amounts from the government grants and growth. These payments are taxable in your beneficiary's hands, typically in a low tax bracket, and your beneficiary ends up paying little to no tax on those payments. If you like this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thanks for listening.